my name is Julie Asti. I'm a certified financial planner with Asti Financial Management, and today I'm going to talk about how to avoid an IRS audit. The first thing to note for an IRS audit is that really a relatively small percentage of returns ever get audited. If you earn under $25,000, about 1% of returns will be audited, and even if you earn over $100,000, only about 2% of returns are audited. So you really have to be doing something kind of outside of the norm to be triggered and flagged for an audit. One of the first things, of course, to do is to report all of your income and report all of your income accurately. This sounds simple, but sometimes people take on consulting jobs, side jobs, that they don't report the income because they feel it was too minimal. As the employer is reporting that income and you're not reporting income that matches it, meaning they're reporting income paid, but you're not reporting income earned, that's going to be a discrepancy that the IRS can pick up on. Also, in terms of reporting all of your income that's earned, this is a really key area for people who work in cash businesses. For example, waiters or waitresses, hairdressers, or taxi drivers. Those returns often are scrutinized because they understand that there's usually a very low wage the person is earning, and they make the majority of their income from cash tips, bonuses, things like that. Another way that you can avoid an IRS audit is to make sure that your itemized deductions are in line with your income. For example, it sounds obvious, but if you make $30,000 of income and you're reporting a $10,000 charitable donation, it may be true and you may have accurate records for that, but that's something that's going to trigger an IRS audit. So they do look. One of the tools that the IRS uses is taking a look at people within the same kind of AGI, adjusted gross income bracket, and what a normal range of itemized deductions are. For example, 30% of itemized deductions for somebody who earns $100,000. There's going to be some certain percentage in relation to the income that's considered the norm. And if you have very high itemized deductions that fall outside of that norm, that could place you in a trigger for an IRS audit. Another thing to take a look at is whoever is going to be preparing your taxes, if it's a CPA, do a little bit of research on the CPA to make sure that they haven't had any violations in the past, because the IRS does look at CPAs or tax preparers who have a history of violations, and possibly unknowing to you, they'll keep them on a hot list. The unfortunate thing is for you as a taxpayer, that list is not publicly available. The only reason you're going to be able to find out is if you really do some research on the CPA via different associations that they would be with, or taking a look online, doing research, consumer complaints, and things like that. Those are a couple of ways that you can avoid an IRS audit. My name is Julie Asti. I'm with Asti Financial Management, and if you'd like to learn more about my company or my services, you can find me online at www.astifinancial.com.